S&P futures up by about 80. And joining us to talk about it is Chris Verrone, the chief market strategist at Strategas Research Partners. Chris, let's start with Friday's action. We just saw it on the screen, and it was a little scary for people who were following along at home. What happened, and where are we this morning with these gains in the futures?
Bit of a wake-up call. You know, if you look at this market, frankly, under the surface, it's been pretty tired for 3 or 4 weeks going into this. It could have been anything. It happened to be the China tweet. But I don't want to lose sight of the bigger picture.
When you say tired, the market was setting new highs every day.
Yeah, when you look under the surface, I mean, we were only operating with about 50% of stocks above their 50-day average. So you started to see some lethargy show up over the last 3 or 4 weeks. But when you look at kind of the big building blocks, which have been tenet to our call, there really wasn't a lot meaningfully wrong. Cyclicals were still better than defensives. Credit conditions were benign. Banks were largely still involved. So I think you have to give this market the benefit of any doubt here. I don't know if yesterday or Friday was one and done, but 6,400, 6,450 is good support. I would still expect we make one more move here higher into year end.
So 6,400, you think one more move higher, what, a couple hundred basis points from here? 65.
Yeah, so 7,000 is kind of what we're still looking at here for year-end 25. I do wonder if 26, if you're starting to set up for maybe a more defensive tone to take shape. We've already seen healthcare start to inflect here. I think the question is, does that bleed into the other defensive corners of the market? So far, you've gotten nothing from staples, really nothing from REITs, and the move in UTs, I think, as we would all concede, is primarily power or electricity driven. So I think the big question into 26 is, do you start to see some shift to the macro, which bleeds into leadership and gets you a more defensive profile in the months ahead?
The reason the market sold off on Friday was because of the president's comments about China and the potential trade war stepping up again, 100% tariffs as of November 1st. It was the worst day for several of the major averages since that April day when the president announced those tariffs to begin with. How much of this is macro-driven, and how much of this is based on what you're actually hearing from companies? We're heading into earnings season. Are we going to hear things that justify the valuations at these levels?
Well, I would answer it from the perspective of what has the market told us about its own perception of the economy. I mean, discretionary has been better than staples, cyclicals have been better than defensive. So if we're going to use the market's interpretation of what the macro and the companies are telling us, I still think conditions are generally in pretty good shape. Credit spreads are 4 or 5 days off their tight. So you haven't really seen anything preceding this that would suggest the market was getting particularly worried about the economy. I do think, Becky, the big question is probably rates. I mean, all year the consensus has been worried about rates up. Right. We've been on the other side. Our story has been, actually, is there some level lower where bond yields actually start to signal the economy may be weakening in a big way? 385 was the low in 10-year yields back in April. I think that's the level people have to keep in mind. Under 385 on 10s, you sit here and you just begin to wonder, what is the messaging on the economy into 26?
Now, you do have some big tailwinds, though, coming from policy actions, the one big beautiful bill. You've got deregulatory moves. How much of that gets baked into this? Because, again, we go back and forth between what's happening on the macro level and what's happening from company specific.
So you have that, plus you have what should be the stimulus of lower yields and lower oil. I mean, oil's at 59 and change this morning. Gasoline futures actually made new lows. So it's up for the stocks to respond to that. I think the most interesting thing in this business is when things don't respond as they should. So I have stimulus into the spring. I have lower rates. I have lower oil. I'd like to see consumer stocks really respond to that coming in to first half, or certainly first quarter of 26. So the information may be if they don't.
Well, I guess you're, again, looking at these inputs, lower oil prices, lower rates, and trying to figure out why they're lower. What do you ascribe to oil below $60?
Well, I think when you kind of hit on the whole story, there's this massive deregulatory push across all industries here. You see it in banks. I think you see it in energy. I don't think it's a coincidence energy stocks were not particularly good in Trump 1.0. They haven't been especially good here in Trump 2.0. When you look at the financials in particular, I mean, the banks have been leadership here for 2 years. So if the broader story is really going to change, I would suspect we'd have to lose financials here. There's not a ton of evidence of that yet. There is some weakness in the private capital stocks, Apollo and Owl and that group of names. But let's remember, if we're going to deregulatory the money center banks, right, if that's where the deregulation is coming from, who has market share to give? I think the private capital names have market share to give. I think the money center banks have market share to take. Apollo underperforming, say, Bank of America has been a very important theme for us.